everyone. Welcome to the second session on real estate and urban economics of ABFER 2021. So in this session, the topic is broadly defined as mortgage markets and credit risk. Just like the 4 papers that we've seen this morning, we have like a set of 4 exciting and interesting papers that are going to be presented. And as usual, the rule is the following. The presenters have 30 minutes for discussion, for presentation, followed by 10 minutes discussion, and then there will be 10 minutes Q&A. And also we'll use the same rule. So for any attendants or panelists, if you have any questions about the paper, please input your comments or questions in the Q&A session as opposed to the chat session, okay? And then after the discussion, we will open the floor for discussion by either reading out the Q&A, or if the time permits that we can probably open it up for even like a conversation, okay? So without further ado, let's invite the first paper. So the first paper is Lending Next to the Courthouse, Exposure to Adverse Events and Mortgage Lending Decisions. The presenter is Mingzhu from University of Hong Kong. So Mingzhu, the floor is yours.
Thanks, Xuan, for having our paper into the session, and thanks everyone for being here. I would very much look forward to your feedback. So today I'm presenting our paper, Lending Next to the Courthouse, Exposure to Adverse Events and Mortgage Lending Decisions. The paper is co-authored with Da Huo from the University of Hong Kong and Yuhai Xuan from the University of California, Irvine. I am Mingzhu from the University of Hong Kong. So now let me spend the next 30 minutes to give you a very brief tool about this paper. So in every business cycle, people spend a lot of effort trying to understand what can happen subsequently in the financial market after an adverse market shock. Especially since the last financial crisis during the 2008 and 2009, there is a large body of literature trying to understand what are the underlying channels through which such adverse market shocks can affect the subsequent market activities. For most of these studies, they focus on the relatively more macro level channels, such as how the adverse shock can deteriorate the fundamentals of financial institutions and drain their liquidity, and therefore constrain their ability to supply credit to the market players, and also how such adverse shocks can lead to a collapse in the collateral value and make lending even harder. Meanwhile, there are also some studies, especially in the recent years, that are trying to explore the relatively more micro level channels, in particular, how individuals' risk preferences and risk behaviors can be affected by the adverse shocks. For example, there are a couple of studies which shows that when this adverse shock can change the risk preference and beliefs of households, it can then further affect their consumption, their investment, and their borrowing decisions, and eventually impact our overall economy. So inspired by these discussions, our paper would like to ask, if, let's say, such kind of adverse shock can also change the risk preference and beliefs of some individuals who are making professional financial decisions on behalf of the financial institutions they work for, then the changing behaviors of these professional individuals can probably even lead to some more substantial and more direct consequences to our market and our economy. So this is the main goal of our paper. In particular, we are thinking about how mortgage lending can be affected in response to the last foreclosure crisis. And if we still think about the traditional macro level channels, then people have talked a lot about, say, how the foreclosure crisis and the negative shocks to the housing market can weaken the bank's balance sheet and constrain their liquidity, which will eventually reduce credit supply to the market, and how the depreciation in housing collateral can makes lending more risky and further constrain credit supply. So on the other hand, when we are thinking about the micro level channels, which we just discussed, then we are asking if the foreclosure crisis and the shocks to the housing market changes the risk preferences and beliefs of, say, loan officers who are making lending decisions on behalf of the banks, then it means that likely their risk taking when making lending decisions will going to be more cautious. And therefore, this is going to reduce the amount of credit they could supply to households and to other borrowers. And we believe that if such a micro-level channel does exist, it can have some very important consequences to our economy. First of all, whenever the lenders, the decision makers become more cautious and reduce lending, it means that the credit crunch can be further tightened, and therefore it will amplify the negative impacts of the fundamental shocks. And furthermore, even when the economic fundamental has recovered, if lenders' risk preferences will persist for a while to be like more cautious, then it means that maybe they will continue, at least for a while, to hoard more safe assets and to reduce their lending to riskier borrowers. And therefore, these can slow down the recovery because now the contraction in credit supply will persist for a longer time. And furthermore, when lenders become more cautious, maybe they will become less responsive to the related bailout policies. For example, they may be more reluctant to participate the programs that can help households to modify or to refinance their mortgages. As a result, such kind of low response can dampen the effectiveness of policies. So given all these potentially important consequences, it can be the first priority for us to figure out whether such a micro-level risk-taking channel exists. And in our paper, we would like to provide micro-level empirical evidence in the US mortgage market during the last foreclosure crisis and the post-crisis period. And in particular, we show that when loan officers who are making lending decisions are more exposed to news or to information about the foreclosure shocks, then the mortgage lending standards will become more stringent, even when we control for the same housing market fundamentals and bank characteristics. So this is the key story of our paper. So as we can see here, the main challenge in our empirical setting is to make sure that we can distinguish, we can separate the micro level channel, which impact the lending decision makers, versus those macro level channels, which impact the fundamentals of lenders and borrowers. So an ideal setting should be that if we compare two lenders, one is exposed to news about the adverse shock, while the other is not exposed to news about the adverse shock. But both of these two lenders are experiencing the same economic fundamentals, which means that they are living in the same world that is experiencing the economic downturn or the market shocks. In other words, the lender and the borrower fundamentals should be exactly the same. The only difference is their different exposures, their different awareness about how bad the market is doing. But we know that in our real world, such an ideal setting is not very likely. And more often, this is what we see. So whenever a lender is exposed to the adverse shock, then typically it means that this lender is also experiencing poorer economic fundamentals. And whenever a lender is not exposed to the adverse shock, it means that typically this lender is still facing a relatively better fundamental. So now it means that the micro channel and the macro channels are mixed together. So it's very hard to separate them completely. So luckily in our paper, we find a very unique setting in the US mortgage foreclosure procedure. Specifically, we noticed that whenever a household default on their mortgage debt and they have to foreclose their homes, then all the foreclosure auctions within a county are usually held at the county courthouse. And typically, such events are held at the steps or in front of the main entrance outside the county courthouse. This means that if I am a person who live or work nearby the courthouse, then if I just walk by and observe such kind of foreclosure auction events, then the chance that I become aware of how bad the market is will be higher compared to my peers who are not as close by. So based on this simple setting, here I'm using this simple map to illustrate our identification strategy. So here, each simple square represents a block, and the space between these blocks are the streets. So assume that the courthouse is located at this specific location, and there's a bank branch which is right across the street. Then whenever there are foreclosure auctions going on outside the courthouse, then if loan officers happen to say walk by, say they come to work or go back home, or they just walk by, go to the corner coffee shop to buy a coffee or lunch, then they can easily observe what's going on outside the courthouse and become aware of the overall foreclosure crisis within this county. On the contrary, let's say if there is another bank branch which is still very close by, say just 1 or 2 blocks away, but for loan officers who work in this branch, then maybe they will be more likely to walk along this street or this street, and the chance that they can directly observe what's going on outside the courthouse is going to be relatively smaller. As a result, then we can compare the loan officers' lending decisions in these 2 bank branches and see whether there are any differences. So the idea is that given that both of these 2 bank branches are located in the same county and even in the same small neighborhood, so their fundamentals, what they're experiencing in terms of the local housing market, should be the same. The only difference is that people who are making lending decisions here would have a greater exposure, a better awareness of how bad the situation is. So to summarize what I just illustrate, here is our key identification strategy. We're just comparing the different exposure to the news about the adverse market shock, such that our treatment group are branches that can easily observe the shock. So branches located next to the courthouse, while the control groups are branches that are not that directly exposed to the foreclosure auction activities. However, we are comparing the treatment and control branches within the same county and year, or even within the same neighborhood and year, which means that we can fully pin down any observable or even unobservable local economic and housing market fundamentals. So this is one channel, one macro level channel that is fully controlled for. And furthermore, we are also comparing branches within the same bank and year, which means that we also fully pin down all the observed and unobserved bank fundamentals, such as the bank balance sheet strength and liquidity conditions. Once everything is compared within such the same group, it means that their experience to the adverse market shock is the exact same, and the only difference is their exposure, their awareness. So based on this strategy, here are the main findings in this paper. We find that conditional on the same local and lender fundamentals, first of all, the mortgage lending standards will be more stringent if they are made in those branches that are directly exposed to the foreclosure events, the branches that located right next to the courthouse, such that people can observe the foreclosure auction events. And furthermore, such a difference in terms of the lending standards are not a simple static difference. Instead, they are actually driven by the differences in the sensitivity to the county-wide foreclosures. So intuitively, if a county's housing market is very healthy, such that there's not many foreclosure events going on, then no matter how close I am to the county courthouse, my awareness about the county's housing market is not going to be much different from, say, my peers who live a little bit further away. But instead, if the county's housing market is collapsing such that there are a lot of foreclosure auctions going on, then if I locate right beside the county courthouse, then I will have a much better chance to be aware how bad the situation is, while my colleagues who are just a few blocks away, they cannot directly observe the auctions. So in other words, our effect is driven by these dynamic differences in terms of sensitivity to the foreclosures. And for those exposed branches, their lending standards are just more sensitive to the foreclosure events. And we also find that our results are in particularly stronger for those high-risk applications. For example, for applications with high debt-to-income ratio or applications from neighborhoods with negative house price growth. And also, the promise for our results to be observed is that the lending decisions are indeed made by human beings who work in the local branch. So this is more likely for small banks because the large national banks nowadays, they are using some centralized AI systems for mortgage screening. As a result, we also observe that our results are stronger, are more prominent among the smaller banks. We further show that these tightened lending standards are reflected through both the extensive margin, say in terms of a higher rejection rate, and the intensive margin, in terms of a smaller loan size, conditional on and approved mortgage loans. So together, this means that overall, the credit supply is going to be lower in those exposed branches. So this implication is going to be substantial to our entire financial system. And furthermore, we also try to explore what's the rejection reason behind this outcome, say how loan officers' behaviors are changed. So there are two possibilities. First, if a loan officer becomes more cautious when he or she is aware of the negative market news, the loan officer can just try to spend more time and effort to more carefully screen the mortgage applications and to collect more information. Or alternatively, the loan officer can just become more risk averse, given the same risk level, meaning that the loan officer is going to reject more marginal borrowers with relatively high risk. And we provide evidence showing that likely loan officers simply become more risk averse, but they don't spend more efforts to better screen or collect information about the applications. So these are the main findings. And our paper are related to 3 strands of literature, including how market dynamics shape individual preferences and beliefs, how dynamic changes of credit conditions are driven by preferences and beliefs, as well as the broader literature that investigate bank credit activities subsequent to the adverse shocks. So hopefully so far, I have provided you a big picture idea about our paper. And next, let me spend the remaining time to introduce more details about the empirics. So the main data source our paper use is the loan level mortgage application and lending decision data from HMDA. So I believe that most of you are experts in this field and familiar with the data set. We also collect the county level foreclosure information from Zillow. Unfortunately, Zillow only report a subset of counties for the foreclosure data, but those counties are typically the populous counties with very active economic activities. So hopefully they still cover a large portion of our overall economy. We manually collect the courthouse location based on Google Map information. So we do some data scraping, and the branch location comes from the summary of the deposit data. We then calculate the distance between each courthouse and each bank branch using the Vincent's formula, which is a widely used method in geodesy. It can provide very accurate measure for the distance based on the Earth's ellipsoid. So once the data is ready, let me use this map to show you an example how we classify the treated and control groups. So this is a map for the county of Miami at Florida. So here, this green dot represents the location of the county courthouse. And each of the yellow dots represents a bank branch inside this county. If we zoom in the small neighborhood around the courthouse, and let's say if we draw a 500-meter circle around the courthouse, then for any branch that locates within this circle, we consider them as close enough to the courthouse. So they are the exposed, they are the treated branches. Well, the branches which are still in the same neighborhood, but outside this green circle, say these yellow dots, we call them we consider them as the control group. So basic idea of our empirical test is just to compare the branches inside and outside the green circle and see whether their lending standards are different. And more importantly, as I just emphasized, we are asking whether their lending standards have different sensitivities to the local county's foreclosure activities. And here is the summary statistics. So our first empirical analysis is basically to ask whether the probability of rejecting a mortgage loan application is higher when the decision is made in a branch that is close enough to the courthouse, that is within the 500-meter circle around the courthouse. And here our hypothesis is that the rejection probability should be higher, such that the coefficient beta 1 should be positive. Our regression results support this hypothesis. As you could see from the estimated coefficient, controlling for everything else, if a bank branch is within the 500-meter circle around the courthouse, then the rejection probability is going to be around 1 percentage point higher. And given that overall the mortgage in the mortgage application procedure, the rejection rate is very low. It's only around like 13% in our sample. Such a 1 percentage point increase in the rejection rate is actually a substantial difference. And we also show that if we further narrow down the range, say by drawing a 300-meter circle, our results remain robust. But alternatively, if we try to go beyond 500 meters, say look at the ring, say the 500-meter to 100-meter range, the result quickly diminishes. So it becomes no longer significant, which again suggests that this result observed based on the location of the bank branch should not tell us anything about the differences in terms of neighborhood economic fundamentals. Given the small range, it is very likely driven by people's exposure, people's behavior changes when they are aware of the foreclosure events. And furthermore, we show that this result is driven by the dynamic sensitivity to the county-wide foreclosure. So again, as I just said, the idea is if there is no foreclosure in the county, then we should not observe any differences between the treated branches and the control branches. Only when there are a lot of foreclosures going on, we will see the difference. As a result, by interacting the treatment indicator with the county-wide foreclosure intensity, we should expect the coefficient delta to be positive. And this again is exactly what we observe from the regression results. Furthermore, we know that the rationale for such a courthouse effect is that whenever the foreclosure auctions are held in a county courthouse, people next to it can become more aware of the events. But we also know that such an awareness is more likely when the foreclosure auctions are held in person. So you can see the crowd gathering around that location instead of if the auction is held online. And also, if the auctions are held outside the courthouse, then whenever you walk across the street, you can see it. Instead, if the auctions are indoor, then the chance you observe them might be slightly lower. You may still be able to say observe people walking in or out, but you cannot observe the whole procedure. Based on this idea, we further try to separate the different types of auctions, and we find that our results are mainly driven in those counties that hold outdoor options, which is exactly consistent with the story that we're trying to tell. And furthermore, we also consider how borrower risk affect this decision consequence. Given that the mortgage screening has a very low rejection rate, it means that this is likely a lemon dropping process. Loan officers just spend most of their time and efforts trying to pick out the bad applicants, the lemons, and try to reject them. This suggests that the marginal applications are actually the ones with relatively high credit risk. And whenever loan officers change their risk taking and whenever they become more cautious, it means that they will reject more marginal applications, and these are the high-risk ones. As a result, we would expect the courthouse effect to be more prominent among those high-risk applicants. And in particular, if we compare the debt-to-income ratio across different borrowers, we find that our results are mainly found among those high debt-to-income ratio borrowers, the high-risk ones. And similarly, our results are mainly found among borrowers who come from neighborhoods with negative house price growth, while in neighborhoods with positive house price growth, we don't see any effect, and the coefficients are also negative. Furthermore, as what we just said, in order for such a micro-level behavior channel to work, we have to make sure that the lending decisions are indeed made by human beings who are in the local branches. So this is more likely to happen for smaller banks. And for large banks, they can use automatic systems, and all the screening process can happen in some mortgage centers, which is far away. As a result, we find that this higher sensitivity to the county-wide foreclosure by the treated branches are mainly observed among the smaller banks, which is again consistent with our prior. So far, hopefully we have provided evidences that can convince you that we are identifying a micro-level risk-taking behavior channel rather than any impacts from the macro-level economic fundamentals, given that we're controlling for the county and bank fixed effects, and we are capturing the difference within a very small neighborhood. But some of you may still be worried that, how about if the exposed branches still are in some sense different from the control branches? For example, how about if the exposed branches just for some random reason receive more risky applicants? So in order to further rule out this concern, we run a number of additional robustness checks. Our first robustness check further controls for the local census tracked by year fixed effect. In other words, now we can pin down the local economic and housing market fundamentals within a very small neighborhood. So even comparing within this super small neighborhood, we can still see our effect remains qualitatively and quantitatively robust. We also ask whether those major borrower and neighborhood characteristics are correlated with, say, this distance to courthouse dummy. And in fact, we find that for those treated branches, those branches that are next to the courthouse, if any, they are observing borrowers with actually better characteristics, with better credit quality. For example, the applications that are submitted to the exposed branches actually have lower debt to income ratio and higher portion of white borrowers, and also a higher income growth. This suggests that if any, if, say, our results are driven by unobserved correlations between, say, the exposure to courthouse and the economic fundamentals, then the effect that we observe should go the opposite direction. And furthermore, when we look at the dynamic sensitivity to the county level foreclosure, we don't find any significant correlations with the borrower or local neighborhood characteristics. And we also try to repeat our analysis by using a matching sample test. So for each treated bank branch, we match it with 5 control branches with similar characteristics. And again, we find that our results remain robust under the matching sample analysis. And also, if we look at neighborhoods with similar economic fundamentals, the results also remain robust. The next thing we explore is for what reasons loan officers choose to decline a loan. As I just mentioned, they can either decline more loans because now, given the same risk level, they no longer want to accept the application, or because now they just spend more effort to collect information and better screen the applications and kick out those low quality borrowers. And by exploring the different denial reasons reported by the loan officers, we find that their behavior changes are more likely related to the increase in their risk aversion, conditional on the same observed credit quality. And it's unlikely to be driven by they spending more efforts to collect information. In the last part of our paper, we also show that such a change in terms of the lending standards not only happens through the extensive margin via a higher rejection rate, but also occurs through the intensive margin, because conditional on loan approval, we find that the loan size becomes smaller, as we can see in this regression table. So both the extensive margin and intensive margin together will tell us that if we look at the aggregate credit supply, it's going to decline. So in fact, if we look at the branch level aggregate supply in terms of the total loan number they originate or the total loan amount they originate, you will find that both the number and amount declines for those exposed bank branches. So overall, we can conclude that our paper provide empirical evidence that whenever the individual lending decision makers are more exposed to information about the adverse market shock, they can change their risk-taking behaviors, and this can affect the overall credit supply. So to conclude, our paper provide micro-level individual decision-making channel. And the last thing I would like to mention is that our paper cannot lead to any efficiency conclusions. On the one hand side, you may say that we're telling a behavior story, which means that maybe when people become more cautious, they are actually making less loans than the optimal level. But it could also be the case that ex ante, the lending standard is too lax, and therefore exposed when they become more cautious, it's actually efficiency improving. So we hope that later studies can help us to further shed some more light about the efficiency conclusion. Okay, so these are all I have.
Yeah. Thank you very much, Mingzhu. So the discussant of this paper is Arkodipta Sarkar from Hong Kong UST.
So thank you for having me discuss the paper. So it was really interesting to read the paper, and let me just summarize it briefly. One second. Yeah, briefly, and Mingzhu has already done an excellent work in laying out what the paper is. So I'll be very brief in my summary of the paper. So this paper primarily studies the way exposure to foreclosure news can impact lending decisions, and they attribute the effect to be driven by changes in risk preferences or beliefs of individuals who are primarily exposed to this foreclosure news. And the instrument of salience for this foreclosure news has been the distance of the loan officer's workplace and the county courthouse, because all the foreclosure events are being taken place in this county courthouse. The empirical strategy exploits within county and within bank comparison of loan offices with varying distance to the courthouse. That is the primary empirical strategy, with the idea that within county year usage controls for all the local macroeconomic shocks, and they can neatly identify what happens what happens just because an individual is closer to the courthouse. And the main findings are that there is roughly around 8.2% increase in rejection rate of managers who are exposed to the foreclosure, while 9.5% lower in mortgage origination. So these are the brief summaries of the paper. Now let me lay down my comments. So my first comment is on the broad motivation of the paper. Now to me, the motivation of the paper were twofolds. The first is about identifying whether individuals' exposure to certain newses or events can affect their decision making in a lending scenario. Or there was another possible motivation, is that the motivation about microfounding individuals' preference as a potential cause for aggregate credit misallocation, right? So Mingzhu said that there is, like, the foreclosure events can have aggregate credit impacts. So is this paper about identifying or microfounding whether individuals' preference can have a broader macroeconomic effect of credit misallocations? So if the primary motivation is the first, then there exists a literature that talks about individual exposure to different events, like, say, Great Depressions, exposures to communal conflicts, disasters, and many other such salient events that can affect individuals' preferences and thereby their decision makings. So this has been done not only in the household scenarios, but there are papers that have talked about, say, some kind of exposures that affects their individual preferences in a lending scenario as well. Now the point is then, why is this scenario of foreclosure events or news particularly different? Like, what is the salience of this particular events that we should care about while studying the impact that it might have on the preference formations or belief formations? So would the takeaway be that the existence of temporary distortions in newses can have a permanent effect on individual preferences, or there could be many such temporary distortions in individual preferences that can affect the market allocations of credits and so on? So this was not very clear to me as to what why would this foreclosure news particularly be different from the other exposures or events that can affect the individual's decision making or preferences. Now, if the motivation is the second, which is more about microfounding the preferences, individuals' preferences as potential credit supply misallocations, then this is, to me, it was the more interesting and novel in the context of where the literature is. But then that would require the authors to quantify measures of misallocations in credit across counties based out of, say, some measures by, say, Rustasia Rogerson, who computes misallocation measures. The authors can use that and say what is the amount of these credit supply misallocations or the distortions that is being generated through the individual's preference formations. So this is one broad picture that I would think that the authors could focus on building the motivation more on the second part, because to me the existing literature have talked about the way preference formation affects individuals, like salience of events in individuals decision making, and then this particular foreclosure events, what is the importance or how that contributes over and above this existing preference formation, was something I thought it would be better if the authors could clarify that. The second is about an alternate story of risk risk appetite versus information channels, right? So there is this existing literature that have talked about distance being a proxy for higher information as well. Now, loan officers who are closer to Courthouse, who while walking sees this various foreclosure events that are taking place, can also have higher soft information about the prevailing market conditions. So I'm just saying that that the access to this salience of foreclosure news or foreclosure events can itself convey information about what the market conditions are, different from people who are not exposed to this news. And that would give an information advantage to the borrowers so that they could make their decisions based on this additional soft information which the aggregate county is not getting. So this managers are just getting access to this soft information by walking past the courthouses and seeing these various foreclosure events taking place. So now this information advantage would itself have a higher prediction of rejection or lower loan dispersal, exactly what the paper finds as well, right? So if you know more about the existing scenario in a way that the scenario is not as good through this foreclosure news, that would also predict rejection and lower loan dispersal. Consequently, the observed that effect in this paper could be due to higher information and not necessarily just coming from the preference formation. Now, one particular requirement for understanding whether it's shift in preferences would, so it would mean that if there is actually a shift in preferences or some form of lesser risk appetite being, or some behavioral biases that is being formed in this loan officers, it would mean that they would sacrifice some profits to fulfill their particular preference that has been developed, right? So consequently, this branch is where managers have some biases in the decision making, some behavioral biases or some lower risk appetite, would also lead to lower profits in branches that are closer to courthouse, right? Because they are not taking the optimal decisions because they are having some biases. So one would expect to look at measures of default and see whether defaults are increasing or not, or some form of measures for returns on loans and so on and so forth. Now, lower risk appetite itself also could imply higher screening by managers or loan officers, and that would lead to managers exactly screening each borrowers and disbursing loans exactly as much amount that they would have predicted through their fundamentals as well as softer information, which would lead to higher standard deviation in lending portfolios of a manager in the number of loans that they are disbursing. So this could be a prediction of checking the standard deviation across the lending portfolios within the
Arkodipta,
manager.
you have only one more minute.
Sure, I'll be quick. So Finally, I'll just talk about a bit about the identification. So the primary identification talks about country cross year fixed effect. So it's within county year estimation across branches. So the branch characteristics could be different. While the next is bank year fixed effects, which looks at the same bank, either it's across branches or across counties. So the ideally one would want to look at bank cross county cross year in order to control for all the bank and county fixed effects. So one suggestion would be to look at possible officer rotations from a place that had more exposure to a place that has less exposure and see the difference in decision making. So others are just minor comments that I can possibly tell Mingzhu at some other points in time, but I'll just conclude given the time constraint that it was an interesting paper showing the effect of salience on decision making. The emphasis on the importance of it in credit misallocation would be great. So some more evidence on preference or belief formation rather than information would be great. And I'm just looking forward to read the next version of the draft. So thank you.
Thank you very much, Arkodipta, and thank you very much for both the presenter and discussant. So why don't we do the following? So Mingzhu, maybe can you take a couple of minutes to respond to the discussion first before we sort of open the floor for questions and discussion?
Sure. Thank you, Wenlan. And thank you for the excellent discussion. So I think like the major comments could be really super helpful for us to improve the paper. In particular, I like to talk a little bit in response to the first comment in terms of like what's going to be the implication of our paper. I think for the current version, our what we're trying to tell is more kind of like in between of the two implications. So we're trying to say that because like if we need to think about, say, what's special about the foreclosure events, then it is mainly that this is itself is already an adverse market shock, such that if now people are further, say, changing their risk-taking behaviors in response to such an adverse shock, it means that it will amplify the business cycle. So I guess that's what we're currently trying to mention. So it's more kind of like an amplification effect. And we believe that this can be important because, for example, if there is such an amplification effect, it means that for macroeconomists, when they need to, say, come up with a structural model that calibrate and predict the future macroeconomic behaviors and market behaviors, then they need to consider the potential changes in terms of parameters, because whenever there is such kind of a behavior changes, it means that the parameters are not static, they are dynamically changing as well. But I totally agree that if we can, say, shed more light on the second implication, it will make the paper more interesting and more important. I guess now the obstacle is more like it's more on that it's a little bit difficult to make any efficiency conclusions as when I mentioned in my last slide. But we're trying to explore something that can at least, say, tell us maybe some suggestive explanations about that. But I really appreciate that comment, and I hope that maybe after this we can talk more about it, and I can ask for your more detailed comments on it offline. So thanks a lot for the discussion again.
Pleasure.
Okay, so I think there is one question in the Q&A.
Yeah.
Yeah, so it's a welfare question, so I'll just read it out. It says that should we ban foreclosure auctions outside courthouses? I think it's probably related to one of the questions Arkodipta was asking. And Mingzhu, do you like to respond to this question?
Sure, and thank you, Upo, for the question. I guess overall, this is a very important question to ask because it can tell policymakers a lot what they're supposed to do. And in fact, if we can have a clear answer about this question, it means that maybe by making a small change in terms of the design of this foreclosure procedure, we can have a significant welfare improvement. I guess the concern here is that we are not super sure which direction we should go. As I mentioned, if we believe that now, because we are in like a market downturn such that the credit is contracted such that we actually want to push lenders to lend more such that they can stimulate the recovery of the economy, then it's correct that we should ban foreclosure auctions outside the courthouse such that people are not that nervous and not that cautious, and we can say allow more credit to be supplied in the market. But maybe we can also say claim the opposite, saying that, okay, before people are just like 2 lakhs, they're just lending too much. And now this exposure to the foreclosure auctions are actually correcting their behaviors and preferences toward the right direction. In that sense, maybe we should claim that perhaps it will be a good idea for us to even encourage more such kind of outdoor auctions, such that everybody can be better aware of what's going on in the market and become more cautious in their subsequent lending and investment decisions. So it's a little bit hard to conclude based on the current evidence, but we do hope that maybe with some further investigations or any follow-up studies, we can have a better answer about this.
Okay, I think someone in the attendees may have a question. I don't know if attendees can talk.
Mingzhu, this is Sumit.
Okay.
Can I ask a question?
Sure, yeah.
So I always thought that risk management and line of business in a bank are disconnected. What risk management does is 1 or 2 years later, they catch these defaults. And you're saying there is a feedback loop from risk management to the line of business loan officers. Loan officers are typically on a 2-year rotation. So why would they care? I mean, this kind of goes back to Arko's question. You need some kind of a loan officer rotation identification strategy, or you need bank times county fixed effect. County is too broad. I just think there is so many other confounding factors that you could be picking up in explaining your result. I just don't know what you're picking. I actually don't think you have any causal story you can make here. I don't even know if this is a correlational story you can make, unless you have some very tight specification that I could believe.
I see. Thanks a lot for the comments. Actually, we have been struggling about this for quite a while because we know that, especially in the US market, it can be very challenging for us to find, say, to actually observe each specific loan officer's behaviors and their status. So as you can see here, now our paper, like we can only try our best to infer loan officers' behaviors based on, say, the lending decisions as reported by the bank. But unfortunately, so far, we cannot say directly observe, say, which loan officer it actually is. I also try to talk to some friends at Fed and see whether they have, say, better data or better idea how we can, say, further polish the identification. But it seems that even say in terms of like the internal version of HAMDA, which they can have like more high frequency records in terms of like at which specific date the loan is approved, but they still don't have the information about the loan officer. So actually, I wonder, because you are the expert in this field, whether you may have any idea, say, if there is any other data sources that might provide some better information about, say, persons who are making the lending decisions.
I don't have any ideas. I would say there's always a good idea to move on and do something different.
I see.
I'm joking. I mean, but I think unless you have some cleaner identification, it's just very hard to believe this project.
I see. So maybe we need to like try to develop better, like cleaner identification to further reinforce
or
our.
Just think about it that this will not go to any. I mean, finance journals and even econ journals, they have very high standards. So all the time you put in and effort you put in, is it worth it then?
I see. So maybe we need to consider switching the direction a little bit, how to, say, pitch the paper, right?
So let me also sort of suggest, I'm not sure how far you can go, but at least I would like to see something along the line. Can you show that the loan demand doesn't change between the branches that are close to the courthouse and the farther away from the courthouse? I know you've looked at the rejection rate, but I also want to see whether people and borrowers change their preferences, for example. That's reflected in the applications, because you observe the application data, right? So, and then what type of borrowers what type of applications are different. So something along that line. And also, I think conceptually, I want to follow up with Sumit's point, which is I actually don't understand why would these personal loan officers care, because their KPIs are about commissions of the loans that they earn, commission on each of the loans they originate. It's not about whether the loan are going to default or not. By the time the loan is going to default, they're either out of their current position or they're not directly punished. So so that's why I'm a little bit puzzled by your finding that actually the firms or the banks that actually are more likely to use machines are less affected. I would actually expect the other way around, because I thought the managers will have a higher stake. So they are more worried. So if they observe that the nearby courthouse have, or they're affected by the salient shock, and their KPIs are more directly affected, and they're more likely to kind of impose a stringent screening standards, as opposed to the actual loan officers where their performance is entirely tied to the loan origination business. Sure, you don't have to respond now. I think also we can chat maybe offline because we're running out of time. Then we can chat later on. So maybe let's move on to the next paper if you agree, if you don't mind.
Sure.